Good morning, everyone, and welcome to the Seraphim Space Investment Trust full year results webinar. I will shortly hand over to the Chief Executive, Mark Boggett, and Chief Operating Officer, Sarah Shackleton, to run through the results presentation. Once the presentation has concluded, there will be a Q&A session. Please use the written Q&A function to ask any questions to the team, and then we will work through them as much as we can. This presentation will also be recorded and made available to view on the SSIT website later. I will now pass you on to Mark to begin the presentation.
Good morning, everybody. Thank you for taking time to come and listen to us this morning to talk about our full year results. So we started off with a slide here that really has the headlines of today's results announcement. I'm not going to work through those. I've left them up as we've been coming on board. Will is not going to be able to join us for this call, so I'll take you through the details as we go through the presentation. So I'm Mark Boggett. I'm the CEO and one of the founders of Seraphim Space, the manager of the investment trust. I'm also joined today for the first time on one of these presentations by Sarah Shackleton, who's our Chief Operating Officer. So before we go into the detail of the full year results, I just wanted to take a step back and remind folks about the big picture for Seraphim. So first of all, Seraphim is the world's most prolific investor in space globally. We've got a portfolio of over 100 space tech companies across our public and private portfolios. Seraphim was the first VC in 2006 to launch a fund focused on space, and the Seraphim Space Investment Trust represents the world's only publicly listed investment fund focused on space. So our partners and backers include some of the world's largest space corporates, multi-billion-dollar size corporates globally, companies like Airbus, MDA, SES. So these are huge backers of our fund. We get to see a giant, massive global deal flow, given our position in this market. We're seeing virtually all deals at all stages. These are private companies, and they're providing us with information, and that provides us with an information asymmetry, which is key to our investment strategy. So as we see deals, we triage them between early and late stage, with the early stage companies going into our affiliated Space Accelerator program, which is the largest accelerator program of its kind in the world. And then when we invest, we're value add investors. We're hands-on. We join the boards of most of the portfolio companies. This allows us to add value, and it also allows us to build conviction about the companies that we're invested into, because we're seeing it from the inside. So when they're coming to do their future rounds, we've determined whether we want to support them and to what extent that we do. So this information asymmetry, understanding all of the players in the market, this is the bedrock of our past success, and we believe our future success. So now let me turn to the results for the trust. So let's start off with the highlights, or rather, regretfully, the lowlights. So NAV per share fell from £1 to 93 pence during the course of the year to the 30th of June. So the market has been pricing in much heavier falls in our valuation into our share price, with a discount at record levels on the 30th of June. Net assets of 222 million were valued at only 65 million by the market on the 30th of June. And this was the reason why the board implemented a share buyback program, because we just felt the disconnect between the real value of our assets and how the market was valuing them was just so far off. There's now been a recovery in the share price today at 38 pence. The market capitalization is 100 million. So looking at the charts on this page on the left-hand side, you can see that they range from the MSCI climate indices to the MSCI defense indices to the FTSE all-share indices. And what you can see in common here is that most of these benchmarks are up over the year, whereas SSIT and our listed growth peers have all witnessed further falls. The share price performance of SSIT as you can see in the right-hand chart, closely correlates with the AIC peer group, other than in the period to the 30th of June, the quarter to the 30th of June. So these are our peer groups are trusts like Chrysalis, Schiehallion. So as the yellow line shows that during this period, there was relative underperformance by SSIT, which has been recovered outside of the period since we launched the share buyback program. So the current risk-off environment doesn't favor investment vehicles exposed to privately financed growth stage businesses. During this presentation, I hope to convincingly explain why SSIT will be well positioned to close this discount gap when sentiment towards technology and growth in private companies starts to recover. SSIT has a number of clear and increasingly evidenced drivers that mark us out differently to the generalist nature or generalist tech nature of our AIC peer group. So let's dig into the detail, starting here with the attribution analysis table. So let me walk you through this table. 4.9 million in new investments and 12.2 million in follow-ons during the course of this year. We've been naturally more cautious about making new investments whilst we've been actively supporting the portfolio. 3.3 million in proceeds from disposals during the course of the year. So we actively started to sell down one of our listed portfolio companies, Arkit. The average price that we sold down at was $8.43, compared today to a share price that's less than $1. 2 million has been realized from this sale and an exit of one of our earlier stage portfolio companies. There's also been a reduction in the unrealized fair value of 5.7 million during the year and a 4.7 million unrealized FX loss. So overall, there is 187.4 million fair value of the portfolio. So at the end of the year, that represented a 1.3 million increase. Now, let me emphasize that the private portfolio has performed very well over the period. We're delighted with the performance of the underlying private portfolio, but we've seen significant falls in the valuations of the listed portfolio companies, mainly as a result of Arkit and AST raising discounted or highly structured equity rounds that have adversely impacted their share price. So the share price reductions of 3 of our listed portfolio companies have led to an aggregate decrease in fair value of 9.1 million. So this has largely been offset by the performance of the private companies, but has still led to us having a decline over the year as a whole. So this next table sets out the NAV bridge. 16.9 million decrease in NAV value. That's a 7.1% decrease over the year to 222 million. Importantly, we've got 35.3 million of cash, liquid resources, nearly 16% of NAV as at the 30th of June. So NAV decreased from 239 million to 222 million during the period. Besides the 10.5 million decrease in unrealized fair value, other contributing factors were 2 million realized loss, the management fees of 2.9 million, and expenses of 1.9 million. So the NAV per share decreased during the period from £1 to 93 pence. Importantly, the company's got this 16% of NAV in cash, and we continue to support the portfolio going forward. So this slide provides a snapshot of the portfolio. Over the past year, we've seen strong performance in the underlying portfolio. Private companies in the top 10 experienced a NAV-weighted average growth of 34% in revenues, and incredibly, nearly 200% increase in average bookings. So these are contracted future revenues. So this is where the company sells multi-year packages of its products. I emphasize that the private portfolio has performed very well over the year and has increased in value by 19%, whereas, as we've already talked about, the listed portfolio has seen significant falls, mainly as a result of ARKIT and AST, in particular in relation to falls associated with their highly structured equity rounds that have adversely impacted their share price. It's been a really strong year for fundraising, however. 360 million has been raised by the portfolio, and this has resulted in the portfolio being very well capitalized. On average, the portfolio has 20 months of cash runway as from the 30th of June. Now, this chart is drawn from the Seraphim Space Index, and what it demonstrates are transactions by volume indexed back to the 1st of January 2018. And what the chart shows, the green line are the number of space transactions that have closed, and the dotted yellow line is the number of general technology VC rounds that have closed. And you can see here that there is a marked difference between the two. You can see that from 2020, Q1 2020, that the number of space transactions that have closed has just continually risen every quarter, whereas the general technology VC market has really tailed off in line with the macroeconomic environment. So why is this? Well, the reason is that space is very much linked to the defense market. The defense market, because of the geopolitical situation, has seen a very significant growth in defense budgets around the world. They're typically 2 or 3 times larger than they've ever been before. Now, these defense organizations are going through a period of investing in the digitization of their capability, and space and data from space is very much at the top of the spear, at the tip of the spear, for where they're interested in building their capability. So this is the reason why we've seen a continued increase in the number of companies that are getting funded. It's because these companies are very much in demand, and there are significant global budgets to support these businesses in their growth going forwards. So here's another new slide that we've introduced for this presentation. And this demonstrates how the chart that I showed in the previous slide, how that's really filtered through to the trust being a major beneficiary of fundraising resilience in this market. So a busy slide, and I apologize for that, but let me help you understand it by starting with the donuts on the left-hand side. So this is a clear statement for the last 12 months. The portfolio has raised 11 funding rounds. So these are existing portfolio companies that have come back to the market to raise more capital. Of those 11 funding rounds, 7 were valued as up rounds, increase on the price of the last funding round, and only 1 was a down round, and the rest were flat. Now, the reason for this is partially because of the economic backdrop that I've talked about, with the largest customers being from defense and intelligence, and the clarity of the budgets that are available to this market over the years ahead. But like in any times of macroeconomic challenges, there's a flight to quality in relation to investing into companies. We've also seen that there's been a real strength of our co-investment syndicates who've come forward and continue to support the funding rounds of the portfolio. And then we've also seen continued evidence of increased investor appetite. So there's a whole range of new investors that have been brought into this market during the course of this year that include private equity investors like BlackRock making their first forays into the new space market. So the right-hand side of the chart, let me explain this. The chart shows the cash runway of our portfolio. We've anonymized all of the portfolio companies there. This shows a 24-month period, and those that are on the edge there are beyond 24 months. And what it signals is the strength of the syndicate. So this is our co-investors and their ability to continue to support the portfolio company in later rounds. So what it really is it's a measure of the reliance on SSIT for future funding rounds. So the different size blobs relate to the different size fair value of the underlying portfolio companies. So what you can see from the outset is that most of the portfolio are really well funded and that they've got strong syndicates. Indeed, only 4 companies have a cash runway that is sub 12 months. And the largest company you can see there by the largest blob, that company is imminently closing a funding round. So, so what you can see also is that many of the companies are bunched at the plus 24 months. So you can see that the portfolio and indeed our largest holdings are now in a strong position. In fact, numerous of them are projecting that they will reach cash flow break even without requiring any additional capital. So the most material of those that have got the shorter runways, as I've described, are now in advanced process for accessing that capital. So the key takeaways from this slide are that on average, the portfolio has 20 months of funded runway from the 30th of June, and that with 35 million that we have left in cash, we remain really positive about our ability to continue to support the portfolio in the year ahead. So this time last year, we had 57 million of cash, and we've now got 35 million of cash, and we believe that that is more than enough to continue to support the companies at the pace of development that we've done during the course of this year. So now let's take a look at the investment activity during the last 12 months. So I won't dwell too much on this slide. We're really focused around the core portfolio, where we've made 2 new investments and 3 follow-on investments. The key message here is that we've continued to take a very measured approach to deploying capital. And this is, of course, given the difficult market conditions, but importantly, our own uncertainty as to when SSIT might be able to raise additional funds. We've continued to support the portfolio companies that we've got the greatest conviction in. And we've also continued to selectively add a small number of new companies to the portfolio. We've been making relatively small investments. This enables us to be able to have a seat at the table, to get to better understand these businesses from the inside, so that in the future, when they're raising their next rounds, provided that we've got more capital available to us, we can make those investments with conviction. Now let's look at those companies in some detail. So first of all, we've got Voyager. So this is one of the space station companies. NASA is retiring the International Space Station at the end of the year and has been financing a broad range of companies to establish private space stations. Voyager is one of those leading companies. We've invested 2.5 million into its B series, and this business is really making progress. This business is unique to our portfolio in that it's built itself through a series of M&A. So it's made some really interesting additional M&A since we invested, and the business has also signed some major contracts with the likes of Airbus and Lockheed Martin. So this business is really one of the leading players within this new market and is really progressing well during the course of this year. So Taranis is a company that's focused on the agriculture market, using data from space to help farmers become more efficient. We've invested 2.5 million in their B series round, and this company is really focusing on its capability in the US, growing out its US sales team, and gaining early traction in one of its new products, which is around carbon monitoring. So we think that's a really exciting new future growth market. So the next 3 companies are companies that we're already invested into, and we've then supported their financing round for the year. So the first one there is Satellite View. Now, this is a company that we're particularly excited about. We believe that this company has got the potential to become one of the future stars of the portfolio. So what they do is that they have a unique infrared sensing capability from their satellite that's now being validated. So we invested 2.1 million in their round earlier this year, The company subsequently launched its first satellite, which is now operational in space and working exceptionally well. What they're able to do is they're able to look from space down to the ground and look at buildings and understand what's going on within those buildings, or they can also understand the building itself, what the thermal efficiency of that building is, what are the leakages from that building. So this kind of data is very much in demand. And the company, in the 6 months in the run-up to the launch of its first satellite, signed contracts worth more than £100 million from customers that are looking to be earlier customers accessing that data. So we're really excited about the outlook for this particular company. Next of all, Deorbit. So we participated in an internal round in December 2022 alongside other shareholders investing 5 million. Now, this company is the market leader within the space transportation market, and it's really breaking away from others in the field. So this company has a multi-stage business model where once they've undertaken their first business model, which is to actually provide a taxi service into space, they then start providing a range of in-space services. So this business has had an exceptional year commercially. It's signed a range of large contracts and is really firing on all cylinders. Finally, we have Planet Watchers, whose round we supported in August 2022, investing 3 million alongside other investors. Now, this business has had a more challenged year. It's not met the targets that has been set, but it's focused on a really important market. We believe that this company has potential, huge potential still ahead of it. What they do is they use radar data from space to focus on the insurance crop market, where the insurers provide insurance to the farmers to protect them against extreme weather events, the fires, the floods, the tornadoes. And what this company is able to be able to do is, in close to real time, evaluate the impact of these events, so that that can then be used as a source of truth for the insurance claims process. So a challenging year for Planet Watchers, but we believe that this business is well positioned to be able to recover as we go ahead. So here's a snapshot of the portfolio, focusing on the right-hand side of the screen there. We've listed the top 10 portfolio companies as measured by fair value and percentage of NAV. You can see there that 72% of total assets are made up by the top 10. So when you take that there's 16% of NAV in cash, you can see why we really exclusively focus on the top 10 companies when we are talking about the fund, because this is really the driver for NAV. Now, what we can say with great confidence is that all of these top 10 companies are market leaders within their respective markets. These companies are largely focused on the defense market and the climate and sustainability market. And in particular, in the defense market, as we've already outlined, we're in a period of time right now, thanks to the geopolitical instability, that these defense budgets are at record high levels. This means that these are revenue opportunities for these companies that they're accessing, and the companies are thriving as a consequence. Now, the next slide really breaks down the valuation changes for each of these portfolio companies. So let's look at the detail there. And what I'm also going to use, so this is a new slide where it shows the top 10 companies and how their value has been adjusted over the course of the last year. So we break out the fair value change. So that's in green when it's above the line, and blue and green when it's below the line, as in negative. And the blue is unrealized FX changes, and the new investments are identified in yellow. And you can see here that we've listed all of the top 10 portfolio companies. So let me try and draw out some of the activities of these companies during the course of the year, starting off with ICEYE, which is our largest company. We've effectively doubled down on this company, and that conviction is really now paying off. So ICEYE is really one of our best performing, if not our best performing portfolio company. And it's been really focused around supporting the activities of the defense market. So ICEYE signed a contract with the government of the Ukraine during the course of last year. And then that has really acted as a shop window demonstrating the capability of ICEYE to the allies who were working alongside the Ukrainian government. And this has led to a significant buildup of demand for the services of ICEYE. They've been signing major contracts with the likes of BAE. They've won multi-year awards with major players like NASA. This company is commercially doing very, very well. We couldn't be more delighted with how this business is progressing. The business is really heading in the right direction and is serving a market where there is a massive need and demand for its product set, but there's also a budget to back that up. So move to Deorbit next. So again, this is another business that's performing really well. They are a in-space services company. They've signed up multiple contracts this year for tens of millions of dollars. They've been selling to national governments like the Italian government. So the trust participated in a bridge round alongside other shareholders, and this company is in the process of closing another very sizable investment round in the near term. But this company is performing extremely well, and its leadership in the market has really been extended during the course of this year. So All Dot Space is a UK company. They produce miniaturized satellites that connect to miniaturized antennas that go on the back of any moving object that then connect to satellites in low Earth orbit, mid Earth orbit, and geostationary orbit, which is unique. Now, they've produced their initial units. They are now going into the hands of their first customers. So the sales are now starting to happen through this business. So this business is best-in-class capability. It's a large addressable market, and they're now just starting to serve that market. So this company is in the final stages of closing a large undisclosed round. They've already closed the first close of that round. Second close is happening imminently. So Hawkeye 360 next. So this company is around signals intelligence from space. So this company is going from strength to strength. Again, the defense market is really its focus. It's built out its constellation this year to 21 satellites. It's the largest player of its kind in the market. Whilst it's been strengthening, other players in the market have failed. So Kleos, one of its competitors, failed during the course of the year. So this business has been closing many big contracts in the US, but importantly, many big contracts with other governments around the world. So they closed a $68 million D series round that was led by BlackRock. So this is BlackRock's first foray into the new space market. Next of all, Satellite View. So we talked about this one. This one we believe has the potential to be one of the stars of our portfolio. They've got their first satellite in orbit. It's working exceptionally well. They've signed more than £100 million of contracts. Defense is really the largest buyer and earliest user of this capability. They closed a £36 million dollar equity round in May 23. So Leo Labs, so this is a company that uses ground-based radars to look up into space to identify debris and to understand where all satellites are located in space in real time. So they've had a good year. They've closed and opened their first radar in the Azores. So they've now got 7 operational radars, and they've really built up their market share for low Earth orbit. So in relation to the number of satellites in low Earth orbit, they're paid to monitor 75% of those currently. So this company also closed a large undisclosed equity funding round outside of the period. Next of all, Astroscale. So this is a business that does in-space services. They've had a great year. They started off in early 2023, closing a $76 million E-Series round, and they continue to extend their leadership in this market. They've closed big contracts such as a $25 million contract with the US Space Systems Command, $80 million more recently with the Japanese government just after the end of the period. So Altitude Angel next. So this is the company that manages virtual drone corridors, and it's in the process of rolling out a 265-kilometer drone superhighway here in the UK, the largest of its kind in the world. And this company received backing from BT during the course of the year. Planet Watchers have already profiled. So this business is focused on the North American crop insurance market. It closed an $11 million funding round in 2022, but the business has had some challenges, but we believe that the business is still well positioned to address its market. And then finally, Tomorrow.io. So this is a company focused on providing hyper-local, accurate weather. So what's going to happen in the next 1 hour, 2 hour, 3 hour in your location. So this company's launched its first 2 satellites. They're in space, they're working well. They're able to use those satellites to provide a 10 times improvement in the ability to identify rain. So they closed an $87 million E-Series round in June 2023 and are well financed. This business is growing very quickly. We're thrilled with the performance of this underlying company. So hopefully that's given you a good understanding both of some of the commercial and funding elements of these businesses, but also how those have been impacted from a valuation perspective during the course of the year. So this is now my final slide. I'm going to use this as an opportunity to really sort of recap. So space as a market is one that is really being driven currently by the defense market. So the defense market globally has changed very significantly in the last 18 months, 2 years, because of geopolitical considerations, the Ukraine, more recently in Israel. And that's resulted in the budgets of sovereign nations being 2 or 3 times bigger than they've ever been before. This provides a clear visibility on the markets that our portfolio companies are selling into. Now, these organizations are updating their capability because of the onset of war. They're effectively increasing the digital and digitization capability of their capabilities. And space is really very much at the tip of the spear for what these organizations are trying to do. So as a consequence, we've seen our portfolio companies performing well. 34% growth in revenues, which is backward looking, nearly 200% growth in bookings, which are contracted future revenues, where the company's selling multi-year products. So that really demonstrates that these customers are lining up to invest and to buy the capabilities from these companies. What we've also seen are new investors coming to the market, and this is the reason why our portfolio companies have been so successful at fundraising. You've got private equity that have come to the market. So you've got big players like Advent that have bought Maxar at a significant premium, KKR that have bought minority stakes in OHB, a German manufacturer, again at a significant premium. And I talked about how BlackRock have come into the portfolio. So these private equity funds that are the leading players within their markets, conservative businesses, they could be investing into any sector at a discount at the moment, but they're choosing to invest into space at a premium. Why are they doing that? Well, the reason that they're doing that, and these companies are conservative, they typically take a 5-year view. Why are they doing that? Well, they're doing that because the customer has got big budgets that are clearly visible, and then they've got the motivation to invest that during the course of the next 5 or 10 years. So that is a big new investor that's come to the market during the course of this year that's going to support investment into the portfolio going forward. We've then also got sovereign wealth funds. So the sovereign wealth funds, the sovereign nations that are preparing themselves, are requiring new capacity and capability from space. They've trained people over the course of the last year within their sovereign wealth funds to be able to not only identify the leading companies that they should be investing in, but also those same companies to be able to provide major contracts with. So we believe the year ahead is very much going to be the year of the sovereign wealth funds really coming into the space market. So those are two of the major players that are in the market with a motivation to both invest and be customers. But then we also have the climate and sustainability funds. There's trillions of dollars of value sat in these funds at the moment. They're typically 10-year funds, 5-year investment periods, and they've really started to identify space as a market opportunity. It's now very rare that we're closing a syndicated funding round where there isn't a climate or a sustainability fund that's also participating. So during the year, we closed 11 follow-on funding rounds. The majority were led by external investors. This is representing a flight to quality in the types of companies that they've been investing in. And as I've talked about, 7 of those rounds were upward valuations, and only 1 of them was down, the rest were flat. So as a result, Seraphim's portfolio valuations have remained robust, and this is the reason why we've ended the year on 187 million fair value, a 0.7% increase year on year. But really, the position at the end of the year with 35 million of cash, with our portfolio well financed, with an on average 20 months of funded runway ahead of them, this gives us real confidence over the year ahead. This time last year, we ended the year with 57 million in cash. This year, we're ending with 35 million in cash. I'm confident that if we continue with a similar pace of investment, that we've got sufficient cash to continue to support the portfolio companies, but also to selectively continue to invest in other exciting companies that we can then build our position in if we're able to raise money in the future. So I hope you found this presentation helpful. In particular, the information that we've showcased on the cash positions and the valuation drivers. Sarah and I are now open to address your questions.
So there's a few questions come through on the chat. Mark, the first one is, SSIT is aiming for an IRR of 20%. Do you expect to hit this in the coming year, and what actions are you taking to ensure it is achieved?
Yeah, so the 20% IRR, we were very specific that was over the medium term. And, we've gone through this macroeconomic setback where Seraphim and all of our peer group have been marked heavily down. We have our head down and continue to invest in the leading companies within this field. Their underlying performance is robust. Other investors are coming through and supporting those businesses. And we've seen our private portfolio increase by 19% in value over that time period. We've seen our public listed portfolio company behave abysmally in terms of share price performance, and that has really impacted our performance. So going forwards, we believe that we're really well positioned to deliver that kind of return. It has been delivered in our private portfolio, and we expect that over some time in the future that we're going to see a recovery in sentiment for our public portfolio company. So let me just give you an example of why I believe that we are going to see ultimately a recovery in sentiment and the valuations reset themselves. So one of our portfolio companies, Spire Global, is a company that has $100 million ARR revenues. Now that company's got over 500 customers. The revenues are very predictable. They've been accurately forecasting them every quarter and then delivering against those. And yet this business is currently valued at less than $100 million as a market cap. It's listed on the NASDAQ. So they're valued at less than 1x sales, which we believe, is not appropriate for this business. The business is performing well. So that's an example of the type of recovery that we expect to see coming through in our NAV as and when sentiment returns for those type of those companies. So we remain as confident as ever that we're going to be able to deliver that 20% return, but it is over that medium term.
Thanks, Mark. The next question is about the discount to NAV. Obviously, clearly there are some macro factors at play here. There do seem to be some SSIT-specific factors driving a higher than average discount to NAV. What work is the team doing to identify and address this SSIT-specific drivers?
Yeah.
I mean, I'm happy to just start there, Mark.
Why don't you start that? Chime in there then, Sarah. Yeah.
You know, just to say that a number of the peers have undertaken some buyback activity over the last year, as did we. And I think following that activity, we did see ourselves narrowing that discount and coming much more in line with the peer group. So, you know, very much in line with the peer group at the moment, and you know, just continue to keep trying to you know, explain the portfolio and the positive news that's coming out of it.
Yeah, I'll just add to that, Sarah. So, you know, in the last quarter, as the chart showed, in fact, I'll get back onto the chart that shows that. There, the yellow and blue line on the right hand side. There was a period where we were no longer trading in line with our peer group, and our discount just got to a level where it was just so dislocated from the reality of the portfolio. That's when the board decided to initiate a share buyback. That share buyback worked. It brought confidence back to the share price, and the board is keeping share buybacks under review, so we can use that as a tool if necessary going forwards.
Mark, there's a question here, a couple on portfolio companies. Mark has stated in the past that SSIT doesn't invest in launch companies because launch is already overcrowded. What about Auriga Space, and what was it about this company that changed our minds?
Yeah, so I still stand by that position on the launch market. Really, most of the gains have been sort of achieved by SpaceX, and now they've scaled, and they're now offering a very robust service, a very sort of high cadence. So all of the other launch companies are really just marginal incremental changes to what SpaceX is already doing. We see it's really challenging for them to be able to make a significant and sustainable return, given that their differentiation is very limited. So we've always stayed away from the launch market. The reason why we were tempted to make a very small investment in Auriga is because it changes the dynamics for how to launch. It's a completely and utterly different approach. So I don't know of those on the call that are familiar with Hyperloop, but this is the technology that this company uses. It's essentially using electromagnetic field to enable you to be able to move an object over this electromagnetic cushion that avoids that reduces friction, allows you to be able to catapult objects and rockets down the Hyperloop and then ultimately catapulted into space. So it's a very different approach, but it's one that that the science supports. It's already actually been actioned by the US government in the 1970s, and we believe that this has the potential to very significantly reduce the costs of sending a kilo into space. So we made a really small investment because the team were exceptional. What they were doing was highly differentiated, and if this is successful, it's a game changer for the launch market.
Thanks, Mark. A couple of questions on Hawkeye. In a recent podcast, Mark highlighted John Serafini's exceptional approach to corporate governance, holding Hawkeye 360 to similar governance standards as those required of publicly listed companies. Do you actively encourage SSIT's other privately held portfolio companies to operate in this manner? And then the second question is, why did SSIT not participate in Hawkeye's most recent funding round?
So Hawkeye is exceptional in the way that this business is managed. We have an annual get-together of all of our CEOs of all of our portfolio companies, which happens to be on Thursday of this week. And we have Hawkeye and John Serafini talking to all of our portfolio companies about the measures that they've put in place around governance and how they manage their board, how they manage their really, really exceptional advisory board, and how they get benefit from that. So we have an annual event in order to help our portfolio companies get to know each other. There's huge synergy potential. There's huge relationships that can be shared around investors and customers. And then, of course, looking further on, there's also potential M&A opportunities between them. So that's the sort of key feature that we help to support those companies and coordinate this activity. You're absolutely right. Sharing best practice through Hawkeye is the way that we're doing that. So in relation to their funding round, so we invest into companies that we've got conviction on, but we also invest into the companies where we're needed. So this was a funding round that was where we weren't particularly needed. It was led by BlackRock. Lockheed Martin also came through. The valuation was at a great price, and you know, whether Seraphim invested or not in this round wouldn't have made any difference to the actual underlying company. So we're being cautious about our cash, and in this particular case, we decided that whilst we really are supportive of the company and we really believe that things are going very well, that we could step back from this round and rely on the other investors to lead the round and to drive the business forwards. So we're still on the board. In fact, it's the board meeting today, my next meeting for this company. But we're hugely supportive. But those are the reasons we decided to not participate on this and several of the other really well-performing companies that closed rounds during the course of the year.
A question here on the portfolio concentration. Are you over diversified, and would you benefit from a more concentrated portfolio?
So I think the portfolio is pretty concentrated already, isn't it? We just demonstrated that 10 portfolio companies make up 72% of the assets. So the other companies that are in the portfolio are really us putting markers down on businesses where we can, from the inside, see what's going on with those businesses and then be in a position to be able to step up and make more meaningful investments as those businesses start to progress. So I think that we've got appropriate diversification at the moment. There are new areas that we want to invest in going forward. So most of our investments at the moment are in Europe and in the US. And whilst Asia is one of the fastest growing segments of the new space market, so we recently opened an office as the Seraphim manager in Singapore, and we've started our accelerator activity over there, so that we're positioned within the Asian market ex-China to be able to identify the emerging leaders. So I would expect to see us starting to continue to make more investments in that region. So yeah, you know, we think that we've got the diversity about right at the moment, but of course, each new business that brings in a new area of capability. Space is a new and evolving market. There is still very much a sort of a real reason to want to invest into the emerging category leaders within each of these new parts of space. So this is part of the reason why we're continuing to make sure that we're making small investments into the companies that we've got conviction are going to sort of lead new areas within this huge $1 trillion market opportunity.
There's two questions here on realizations and exit potential. So are there significant realizations likely over the next 12 months? And will trade buyers or PE be the likely future exit rather than the public markets and IPOs?
So look, hopefully this has come across in this presentation today, and it's consistent with what we've been saying for the last year. Our business and our portfolio companies are being driven by the defense market, the budgets in the defense market. Now, the players in the defense market are very acquisitive. So this is a market that's going through a bull market. The companies are well financed and they're acquisitive. So there is a high probability that some of our portfolio companies that are clearly demonstrating new capabilities are going to become attractive M&A targets in this market. Now, right now, our preference would be that they don't get acquired, because these companies, even those at the sort of the leading end, have still got revenues in the low hundreds of millions. Our belief is that over the course of the next few years, we're going to add a zero onto that. And our preference is to stay with these companies as they grow, rather than to take a sort of one-off gain through exits. So that is where we are at the moment. Because of the structure of the investment trust, the shareholders benefit from the incremental NAV increases in the underlying portfolio companies. So you don't really need an exit for you to benefit from the growth of these companies. So I'm sure that this is going to happen during the course of the next year or so, that our companies will get picked off. But really, our preference is to be in it for the longer term.
The next question's on the listed companies. What is likely to improve the share price performance of the listed companies, which might in turn improve confidence in the unlisted portfolio?
Yeah. So this is all about sentiment, and really sentiment around the SPAC community of companies. You know, it's an all-time low at the moment, largely because the companies that went through SPACs 18 months ago are now being forced to come back to the market to raise more capital, and they're doing it at terrible terms. So you know, this is sort of self-fulfilling prophecy at the moment, that that's really driving the share prices of these companies further south. But you know, there are companies that are performing well despite this backdrop, and I've already given the example of Spire Global. You know, this is a company that we've been adding to our stake as the company's share price was in decline, because we really believe in the capability and the capacity of this company to grow. So at some point in the future, when sentiment returns, and I don't know whether this is in 12 months or 18 months or 24 months, investors are going to start looking at the fundamentals. And again, to draw on Spire Global as an example, this is a company with $100 million ARR that is today valued at less than $100 million. So that will start to stand out to investors. And when that does, I believe that those are the type of companies that are going to show a nice recovery. And as we've gone through today, our fund is going to be a huge beneficiary when we see recovery in the NAV value of that listed portfolio, because the way that the private companies and the growth that they have achieved during the course of the last year has to a long way reduced the impact of the fall in valuation of the listed part of the portfolio.
Two more questions. One is the insurance market growing as quickly as expected and hoped?
So I think the answer to that is not as quickly as we would like. These companies are you know, very significant, very set in their ways, and are open to trialing and working with new companies, but change takes quite some time. The environment that we're in at the moment, particularly these insurance companies that are subject to climate events, you know, there are a lot of challenges for insurance companies at the moment. So they're not embracing new technology as quick as we like, but we still think that the outlook remains very positive.
A final question is, are any of the portfolio companies anticipating trouble insuring, or insurance being prohibitively expensive for their satellites going forward? Thinking specifically in the context of failing propulsion systems.
No, in fact, the opposite is true. So insurance is more readily available, it's more cost effective. Because the market is maturing, more insurance companies are coming into this market offering more products. And because of companies like Leo Labs that provide minute understanding of everything that's going on in space, the insurance companies have got access to data that allows them to be able to evaluate and price their insurance products more efficiently. So the opposite of true is true of your concerns.
Thanks, Mark. There's no
Great.
further questions.
Right. Well, thank you to everybody for tuning in today. I hope I've been as clear as possible, demonstrating our confidence in our portfolio going forward, confidence in the outlook for our sector, and our position as Seraphim as the leading player in this market. We've given you evidence of underlying portfolio companies' revenue growth and booking growth. We've given you evidence of how our portfolio companies are being well financed and how there is a significant different groups of investors that are at the market with propensity to invest and reasons to do that now, that gives us confidence that this market is heading in the right direction and that we're very well positioned to grow with the market. So to go back to the point that was raised earlier, you know, are we still standing by our 20% IRR over the medium term? I think yes, our confidence levels are as high as they've been in relation to be able to provide the kind of returns that we promised to investors when we came to the market in July 2021. So thank you for your time today.